couple of years, we're going to begin to phase in the different types of securities. And as mentioned before, it's going to phase in over a 3-year period of time. You have this thing again called covered and uncovered securities. And the covered securities are depending on when we are at what point in time and what type of assets. So for instance, in the schedule that you see there, equities are phased in or become a covered investment after January 1 of 2011. So that's the only thing that has to be reported. The following year, mutual funds, exchange-traded funds, dividend reinvestment plans, those come online. And then after 2013, you have other securities like options and fixed income securities like bonds and corporate type of assets. So that's the schedule or the phase-in schedule that will occur. Now, I keep referring to covered and uncovered securities. Here's a definition for you. Covered securities are simply those assets that are acquired after the effective date for the particular security. Uncovered securities are those acquired prior to the effective date. So, and if I go back here for just a second, if you go back to this schedule that you see here, the assets that are covered are just really, again, the ones that are covered after that date. But ultimately what will happen is the custodian will only report on covered securities. And we'll talk a little bit about that more as far as what reporting you will see going forward as this schedule is phased in. Now, the reporting requirements for the custodian is covered on Form 1099-B. And for those of you that have gotten these in the past, it's your regular reporting that you get at the end of the year. But the only thing after 2011, so effectively the first time would be in 2012, which would cover 2011, you'll get cost basis reported for covered securities. Now, the custodians are not required to report cost basis on uncovered securities or things that are required to be tracked at a later date. And this will make a little bit more sense in an example that I have, as well as another chart that I have following this. So bear with me for just a moment here. When I look at covered securities and uncovered securities, this chart will kind of give you an idea on who's responsible for reporting that. So either it's the taxpayer, or it's the broker or the custodian, and in this section here it indicates what they are going to report and how they're going to report it, and over here this suggests that the taxpayer is responsible. And then you have the same schedule that we just saw between the three, and it kind of gives you an idea of where those securities or where those assets should be reported and who is responsible for reporting them. So when I go to a more concrete example, we've got client positions, and in this case the client had 3 stocks or 3 positions in the portfolio, and all of them were sold on April the 1st of 2013. Now on the IBM, because that's an individual stock or an equity, you have 2 tax lots, one purchased February the 26th of 2005, and one purchased early next year, which is January the 15th of 2011. The security that has 600 shares is an uncovered security. The custodian will not report cost basis on that particular tax lot, but they will cover the 1,200 shares which were purchased on January 15th of 2011. So that's considered, of course, a covered security. Mutual funds, which start on January the 1st of 2012, you got 2 tax lots there just as well. The one purchased in 2011 is uncovered. The one purchased in 2012 is a covered security, and likewise for the Treasury bond. So it really ultimately depends on when did you buy the security as to if the asset is a covered or uncovered security. That's really the determining factor. Now, Schwab, as a matter of practice, is going to calculate or have on their systems, just like we do, all of your securities. So in the case of what we're looking at here, if you have IBM shares of 600 and 1200 purchased on different dates, we're going to have the cost basis for each of these particular securities. But on the 1099-B, Schwab will only report to the IRS the covered securities, but they're also going to report to you the uncovered securities as a courtesy. So both of those things will appear, except that one of them will go to the IRS, the other one will not go to the IRS, and really is given to you just simply as a courtesy. The custodian is not required to report uncovered securities to the IRS. So it kind of gives you an idea of what Schwab will do and how the assets will, how the assets will be recognized by them. So you have a big tax position that is covered, that's got a portfolio that has a number of different things in there, and you've got this issue of how is it going to be tracked. Well, pretty soon the media, when they start getting a hold of this towards December and early next year, they're going to begin to throw around some of these terms like, the average cost and LIFO and FIFO and specific selection, and the question becomes, well, which one am I following, and which one is correct? Because you can choose really ultimately any of these methodologies. A custodian is going to use some method of tracking, and for the IRS and likewise for most custodians, they're going to move to the default method, the IRS default method, which is first in, first out, or FIFO. Now, you can direct your custodian to calculate a different method, and that direction can be given by you, the client, or somebody that is working on your behalf, like an investment manager, or like, for instance, us. And but if you don't tell them anything, they're going to do first in, first out, and in my opinion, that's ultimately detrimental to the taxpayer. I think it creates additional taxes, and you'll see why here in a few minutes. The other choices, last in, last out, which is the LIFO that we refer to, high cost basis, low cost basis. They'll just take the highest cost basis or the lowest cost basis of all the tax lots. You can do average cost, and that's really only for mutual funds or a specific or specified lot. And sometimes we use the specified lot when we're doing some tax planning, and we want to sell specific shares for a specific reason at a specific time. And so certainly we can do a specified lot type of situation. But the default method again is the FIFO method. Now, what we're going to recommend to our clients is that they use a high-cost methodology. And in our opinion, this strategy ultimately minimizes the capital gains tax that you pay. And whereas if the security price goes up, the strategy, because we're using high cost, creates the lowest possible capital gain. And if the security price goes down, the strategy creates the maximum capital loss. So in the first case, you pay the lowest amount of tax. In the second case, you get to utilize the largest loss to offset other gains or to reduce your income taxes by the allowable $3,000 of regular income. So we're going to recommend that you use high cost as the methodology.